I'm going to make it easy for people. Everything is about supply and demand. Right? The more supply there is, the cheaper it is. The more demand there is, if supply is stable, the more expensive it gets. Which is why we've had the problem with prices, because there wasn't supply of oil, but there was demand as everybody came out of pandemic. So what have we got going on in ETH? We've got a gigantic supply shock. So what is the supply shock? The small supply shock is, right now, every day, miners are selling ETH. They probably sell 80% of everything they receive because they need to pay for their cash flows and their electricity and all of this stuff. So they stop. That's about 1 or 2 billion a month. Okay, that's nice. But then after that, we've also got the fact that staking's coming. Currently, there's about 9% of all ETH staked. Now, estimates are it should go up to around 30%. What does that mean? It means 30% of the ETH comes off exchanges, comes out of DeFi, comes out of CeFi, and is untouchable. Right? You're removing a gigantic amount of supply from the market, and it's locked for a year, so you can't do anything about it. Yes, you can trade using staked ETH and stuff like that, but it's not the same thing. So you've got this. So you're taking that out of the market. So you've got a huge supply shock. On the other side, you've got a massive demand shock, which is, firstly, a lot of institutions wrongly didn't like Bitcoin because of ESG concerns. Proof of stake gets rid of that. Additionally, it now has a yield. So that's something that institutions love, is a yield. So now you need to make one asset allocation decision, which is, I believe in this Web3 technology world. So where do you allocate? Bitcoin or ETH? It's going to be ETH. Why? Because you're going to get something between a 6 and a 10% yield.
That's right.
So that's extraordinary. And you've got this just deflationary issue of burning the tokens based on network activity. So that's another massive supply shock. So there's less ETH around every year. It's getting locked up. And you've got no miners. Put against this massive demand shock, and we've got the macro cycle turning. I look at this and think, holy shit, this is a massively imbalanced supply and demand situation. We're looking at this as a technology and a network adoption model. So you want to back the network that's growing the fastest and has the most number of applications. That's the safest, easiest allocation. That happens to be ETH. Now, other earlier stage tokens, whether it's Solana or AVAX or whatever, are getting earlier on the adoption curve, so you get that accelerated phase, so that will probably outperform. But if you're just thinking the safe, easy bet, we're now looking at the internet. The money of the internet is ETH currently. Nothing is exchanged in Bitcoin. Right. I mean, literally nothing. So the money of the internet is ETH. DeFi is built on ETH. NFTs are built on ETH. All of this is being built on ETH. ETH has a yield. Stable coins are on ETH. And ETH has a yield. Okay, what's left? Yes, it's not fast enough, so people go to other chains for that. It's a bit more expensive, people go to other chains, but the broad encompassing of the space, this is the simple, easiest bet to take. Clearly, if inflation stays higher for longer and rates stay higher for longer, crypto won't recover. Does it go further and lower? Possibly, because we haven't tested it in that environment. So the macro is one. Obviously, there's always the threat of regulation, but they tend to be temporary in nature. We've seen China, we've seen India, we've seen everybody kind of toy around with different regulations. It moves the markets for short periods of time, and then money gets reallocated through the system. So I think the macro is probably the biggest risk. And because I don't see how the network by technologists is not adopted. The technology genie is out of the bottle, and that's not going away. So every time you trade below trend for an extended period of time, you're getting cheaper and cheaper and cheaper versus the log trend of adoption. So Metcalfe's law makes it very difficult for assets to stay down for a long time, which is why everyone gets frustrated with technology stocks, because they're not cyclical, because they're driven by the same factors. Let's say I'm wrong and there's more pain to come, which a lot of the crypto markets think. So let's say the downside is 40% from here. Okay, that's a decent sell-off from here. What is the upside? Well, every time you've gotten to the bottom, it's around 10x, maybe more.
Right.
And depending which token you choose and how well you allocate your capital. So 40% downside, 10x upside, that risk reward is enormous. It's huge, right? So that's one of the best risk rewards you'll ever be given in your career. What's amazing about crypto, why it generates so much wealth, is because you get repeatedly given these.
Yeah.
And that's why technology has done amazingly for people as well, technology investing.
That's right.
Because people have this mean reversion mind frame and they think it's all over. The reality is it's always going up to the right, just within these volatile bands. We talked about people being underweight in equities.
Yeah.
So I also run a asset management firm called Exponential Asset Management, and we allocate to hedge funds in the crypto space. There are many hedge funds sitting on 70% cash, as there are people like Kotu in the technology investing world, 70% cash. Where is the path of pain, down or up? Because they've got a big problem to their investors if ETH keeps rallying. They've got a huge problem. Now, part of me thinks, well, does ETH just stop at this kind of 1,800, 2,000 level where there's all that resistance? But that kind of would let these guys in. And the market doesn't do that until they're in, and then it corrects sharply. People don't yet realize what NFTs are. Everything we do in life, including me coming on this podcast today, is a contract. An NFT is a unique contract. Forget everything about what it's being used for currently. Almost everything we do, from derivatives in financial markets, through to insurance, through to attending a concert, through to education and getting a certificate or anything, they're all contracts. The technology now allows these contracts to be verified and all the stuff that we know with blockchain, right? So you've now created a global marketplace for contracts. But the first thing that came out of it was art, bizarrely enough.
Yeah.
Because this technology allows us to solve a number of issues about who gets paid for what, right? A contract for a piece of art, I buy the piece of art from Damien Hirst directly, he gets paid once. And after that, he never gets paid again because it's not linked to anybody. But the smart contract changes the entire equation. So he can participate in his own network, which he couldn't do before.
Yep.
So NFTs are that. NFTs are another thing, it is the proof case of community and what it means to coalesce groups of like-minded people around single ideas. Whether that's the DAO structure of the Constellation DAO, the Constitution DAO, which didn't actually achieve its purpose, but it was an incredible getting together of capital, $46 million in like 3 days around one idea, or whether it's a shared idea in the IP, which is, let's say, Yuga Labs Bored Ape Yacht Club ecosystem, which is, well, we're building a media company from scratch based around community from the ground up.
Yeah.
So communities can get together and authenticate each other. So it's club membership, it's collectibles, it's shared purpose, all of these things together.